So this is officially has to be the cheapest stock in the market right now. They are not showing JD no love after they killed their earnings. Revenue growth of 15%, adjusted net income of 49%. All of that is canceled. The market is still down 4% on JD.com, even though it killed its earnings. This is all because it's China, the China fear. Just imagine if this company was in the US. It'd be impossible for JD.com to sell it around 8 to 9 PE, forward PE around like a 5. They have a net cash position around 19 to 23 billion. Just imagine how cheap the company is. And it generates around $7 billion of operating income a year. So guys, that's getting into cheap multiple territory. So let's go over what JD.com is talking about. Why is the market so down on JD.com? We're going to get into it in this video. JD.com is selling for $35 a share. It's down 4% for today. Guys, at 8 PE, that's insane. Remember, it's growing 15% of revenue growth. It grew 15% this quarter. They're pretty much talking about they can continue that in the second quarter because they still have this like buy-in program for the government, and there's still a good amount of subsidies getting into JD.com, and people are still buying appliances, the general merchandise. Everything is kind of pretty much going up in this company right now, but the market is not rewarding shareholders for that. They bought back 2% of their shares, so they're still doing buybacks. They still have $3.5 billion of buybacks to do. So we can kind of see them propping up the share price as they continue to buy back, but who knows what's going to happen because, man, it doesn't matter what's happening in the market because the stock keeps going down, man. I'm surprised, even though they had a crazy beat, but man, that's what the market is going to give you. So who cares? The company's still doing good. This company, in my opinion, should be around like $70, $80 right now. If you were going to give it a fair multiple around 12, 13, with that revenue growth, with the future potential of JD.com, even though if you think it's in China and you don't like it, I still think it is extremely undervalued with a forward PE of under 5. They still have $23 billion of cash on the balance sheet. So everything just looks so pristine with JD.com, but the market is just not giving JD.com the multiple or the value that's actually really worth. Here's what's the earnings snapshot. JD.com tops Q1 with revenue up 16% and adjusted net income surging 43%. So I said 15 and 49, so it's 16% and 43% surging of top line revenue growth and net income, adjusted net income of 43%. So that just shows you that it's not a dying company. And that's like kind of like what people are thinking about JD.com, that it's a dying company. And that's why these multiples for JD.com are so low, because you have companies like Baba, like Tencent, like PDD. Everyone says, oh, they have like JD.com can't compete. There's no competition. And people just don't want JD.com for it. JD.com because of that, because they think it's still a dying business. But JD.com, again and again, they're proving that narrative wrong, especially as the customers are growing, service revenue is growing, marketing. There's so much stuff that is going forward for JD.com, but the market is not satisfied with that. And the reason why I think they're not satisfied, the market, because they're getting into this new business, food delivery and on-demand delivery. And that's the hiccup that a lot of people have with JD.com, because they think it's a low margin business, and you already have MetaOne that kind of dominates, and LME that dominates that section. But JD.com is telling you pretty much that this is just right up their alley. This is right up their field. This is not a new business like how everyone's portraying it, because they do logistics, and logistics is like their moat. Like they have facilities, they have robotics everywhere. So doing on-demand delivery is just a product of JD.com getting into that market, competing, because they already do deliveries of healthcare, of groceries. So this is not like a crazy step. And this section of the market, the delivery, is growing really rapid, especially in China. Look at the presentation that JD.com came out with. Solid growth, 15% CAGR from 2019 to 2024. Quarter over quarter, 15.8% net revenues. The net product revenues grew year over year 16%. Net service revenue 14%. So like they're growing. Like this is a solid company. 70% year over year for the electronics and home appliances, general merchandise. 14.9%. Even the clothing is growing. The marketplace, 15% year over year. Logistics, 13%. So they have a good spread. And this is what I'm talking about, 18% for the new businesses. And this is the home delivery section. So the margins are still going good, like they're increasing. So that just goes to show you that even though they're getting into the new business, we're going to see the next quarter how much margin contraction is going to happen because they are getting into a new sector. But long term, the company is telling us that the margins are going to continue at high single digits. So let's see if they can kind of still maintain that over time. 4.1% for net profit margin. So the margins are still solid. So let's get into the earnings call, because if you're just looking at the numbers, everything is just going straight perfectly. So it doesn't make sense why the market is not valuing JD.com at the appropriate price. But we're going to see maybe something in the earnings call came up and people don't like it. But from me reading it, it doesn't seem like that. Now I'm going to talk about the things I like about this earnings call, because this is showing you like the growth potential of JD.com. The supermarket offers massive market scale with fragmented players and relatively low online penetration. So we see a lot of headroom to step up our growth and profit improvement in this key category. The roadmap to scale our fashion business scale and strengthen user mindshare. We anticipate strong operational tailwinds throughout the year. We expect supermarket, fashion, other high potential growth categories within the general merchandise, which we are only beginning to unlock to further propel our long-term growth trajectory. You can just see how they're actually very bullish on the continued growth just this year. Moving on to our user growth and engagement, another bright spot in Q1 during the quarter, our quarterly active customer number was up double digits year on year with increased average user shopping frequency and notable acceleration. So the customers are shopping, people are still loving JD.com, they're going on the site, they're buying a lot of things. On top of the cheap valuation, JD.com is dedicated to return money to us shareholders. That's what I love about this company. It's selling at a cheap multiple and they're still delivering value to us. We remain dedicated to delivering shareholder returns. In April, we completed our new cash dividend payout, 1.4 billion or $1 per ADS. In terms of the share buybacks year to date, in 2025, we repurchased a total 8 million Class A ordinary shares. So they accounted for a 2.8% ordinary shares reduction. So guys, and they still have like $3.5 billion on their buyback. So they're doing the right things. They're giving us a dividend. They're buying my shares. They have a high earnings yield, free cash flow yield. They're still growing 50% top line. Their margins are improving. They're getting into a new business. That might hurt margins, but I see that overall being very strong because it can continue the revenue growth going out into the future and get more customers in the JD like atmosphere and like scope. So all that is actually very positive for me as a JD.com shareholder. So I'm happy with that. As you can see, JD.com is selling for a very cheap multiple, under 10, still growing revenue around 15%, bottom line still growing 43%. So the multiple is just ridiculous. It's so undervalued and they're getting to a new business sector. That's the only reason why I can see people are kind of afraid, because they think it is going to be all cash burn. So it might be a lot of cash burn up front, but they have the cash to kind of back that up. As they have around 19 to 23 billion, they're still generating operating cash flow of 7 billion. So they can generate the market cap of the business in probably 3 to 4 years if you're minusing the cash off the market cap, and you get like an EV around around 23 to like $30 billion. So you can easily see how this can work out very, very fast. So guys, what do you think about JD.com? They're beating earnings. The stock is still going down, but I'm still bullish. I still have a large position in JD.com. Guys, what do you think? Like and subscribe.